Good day, I'm Rupert Giesing, Business Development Manager with Equilibrium Investment Management. With quarterly statements going out soon, we wanted to give you a quick update and overview regarding markets and the performance of our multi-asset house view solutions, which includes the MFP Focus model portfolios and the Momentum Focus fund of funds. September 2022 was no exception to the September effect, which refers to the historically weak stock market returns observed during the month of September. In fact, September has been the worst performing month on average going back nearly a century. Global equity markets suffered substantial losses during the month. The monthly drop in the S&P 500 index was the worst since March 2020, and the 4.9% decline in the third quarter followed losses in both the first and second quarter of the year. The last time the S&P 500 index experienced 3 consecutive quarterly declines was during the global financial crisis between mid-2007 and early 2009. With central banks worldwide adopting an aggressive approach to monetary policy to rein in soaring inflation, the sharp tightening in global financial conditions has triggered concerns over the health of the global economy. The Bloomberg median consensus expectation for a recession in the United States in 1 year's time has climbed from 15% at the start of the year to 50% at the end of the third quarter. The probability for a recession in the UK has gone from 15% to 60% over this time frame, while the risk for a recession in Germany ranks the highest at 77.5%, up from 17.5% at the start of the year. For risky assets like equities, it does matter where the global economy experiences a recession or not. History has shown that equity drawdowns were much bigger and of longer duration in recessions than in non-recessionary slowdowns. In summary, it is most probably going to get worse before it's going to get better. During times of uncertainty, the defensiveness of safe haven assets like US bonds and cash becomes more attractive. Global property fundamentals remain solid, however, but the yields are currently expensive versus investment-grade bonds, capping the return potential for the asset class. Locally, due to their cheap and absolute relative valuations, South African equities could either hold up relatively better during global equity drawdowns or at least provide better returns during subsequent recovery phases. South African real bond yields are attractive versus global yields and are also higher than their historical average. The prospective SA real cash yield has been rising from a low level in line with policy rate increases and is now only slightly below historical averages, whilst the potential for meaningful South African listed property return upside from undervalued levels needs to be weighed against some remaining negative fundamental factors. During periods of increased market volatility, it can be easy for our recency biases to get the better of us, but we have to remain aware of the long-term return potential for all asset classes, and that our multi-asset solutions are already positioned to capitalize on these returns. Here with a quick overview of the returns of all asset classes as at 30 September. We can clearly see that there is a big difference between short-term returns over 1 month and year to date, for example, and returns over the longer time horizons, especially so for the more volatile asset classes like equities. But that is also where the real growth potential lies in the long term. In constructing our multi-asset solutions, we are well aware of the significant potential for short-term volatility in some asset classes. This is incorporated in our portfolio construction process and directly related to the minimum recommended time horizon of the specific solution. If an investor's objectives did not change, there is no need to make changes to their investment portfolios during times of excess market volatility. In fact, market volatility often creates significant mispricings and buying opportunities for portfolio managers, which means that when markets start to recover, and they always do, investors will be ideally positioned to participate in the market recovery, but only if they stay invested. More often than not, one will not time the market correctly and lock in losses when switching to the perceived safety of cash during uncertain times. I would like to also remind you of the following slides that Dean shared at Outcome Matters, comparing the outcome of staying invested versus switching to cash during the perceived previous bear market that was only just 2 years ago. The comparison was done from January 2020 to June 2022, looking at investment in the Momentum Enhanced Yield Fund versus the Momentum Focus 7 fund of funds. It is very important to remember that the purpose of this comparison is not to show that one solution is better than the other, but to illustrate where one would have been if they remained invested, irrespective of short-term market volatility. The first chart compares the outcomes of staying invested in the same portfolios throughout the crash of 2020 up to June 2022. The total return would have been 16% for the Focus 7 fund and 15% for the Enhanced Yield fund. The second graph shows the results if an investor started in the Momentum Focus 7 fund of funds on 1 January 2020 but de-risked and moved to the Momentum Enhanced Yield fund on 31 March 2020 because of short-term fears. After more than 2 years, the investor would still not have recouped the losses incurred in early 2020 and would have been down 10% on their initial investment. In the third example, we assume that the same investor re-risked and moved back to the Momentum Focus 7 fund of fund at the beginning of 2022, given the strong returns from equity markets in 2021. This is a classic example of trying to time the market and shows that the investor would have been down 18% on their initial investment by switching back. This is a total return difference of 34% to the investor that stayed invested. To put it differently, that is 54% value destroyed simply because an investor overreacted to short-term market movements and switched out. In line with expectations, all the multi-asset solutions have had subdued returns over the past quarter, with the longer time horizon portfolios being impacted more. Even though these returns, especially in the more aggressive portfolios, have been disappointing, the funds have done very well to cushion investors from market volatility due to their well-diversified nature. Returns over a rolling 12-month period are also still well within the internally defined risk measures that we have in place for these solutions. Please remember that returns longer than 12 months for the MFP Focus model portfolios are simulated returns. The numbers have also not been finalized yet due to time constraints, so there can be a slight difference to the official numbers that will be published on the September 2022 fact sheets. I'm now going to hand over to Emily, who will give you an overview of our cash and income solutions, covering the Momentum Enhanced Yield Fund, Momentum Money Market Fund, and the Momentum Flexible Income Fund.
Thank you, Rupert. Good day. My name is Emily Mahoko. I'm the fund specialist at Momentum Collective Investments. Domestically, the SARB increased their pace in hiking with 2 consecutive 75 basis point increases in July and September MPC meetings. We remain of the view that the SARB will continue to hike in step with the global central banks. Over the quarter, we have seen the ALBI delivering positive returns, still outperforming South African equities and property. Cash was once again king for the quarter, returning above 1%. The inflation-linked index, as measured by the CELI index, returned negative 1%. I'll now be looking at the Momentum Money Market Fund. The fund invests in short-term fixed income instruments issued by banks, South African government, and South African corporates with a maximum term to maturity of 13 months. The yield is returning to the money market. Rates rose across the maturity spectrum. We are increasing our floating rate exposure, given the interest rate trajectory to be able to benefit from resetting benchmark yields. Bank NCD rates increased in line with the high rate view. The 12-month NCD moved from 7.5 to 8.35 at the end of September. As we have mentioned in the last quarter, for the first time in 3 years, we are seeing real rates in the cash markets. We are still locking in these elevated rates for the benefit of our investors. Cash remains a safe haven for investors concerned about the growth outlook in South Africa and globally. We remain of the view that the SARB will continue to hike for the rest of the year. The Momentum Money Market Fund has managed to outperform its benchmark of STEFI over the relevant time period of 12 months. I'll now be looking at the Momentum Enhanced Yield Fund. The underlying range of instruments in the fund are used as tools to actively manage the fund's interest rate risk. We have increased our floating rate exposure given the interest rate trajectory. We have seen attractive opportunities in the offshore debt of local companies and have allocated capital where the valuations were attractive. We aim to generate a high level of income from the credit assets in the Enhanced Yield Fund at a low level of duration risk. We view the income generation capability of credit spreads as the important driver of overall returns in this fund. We remain a valuation-based team with a risk-adjusted focus on returns. We believe there are good returns for clients over the next few years in South African fixed income market. At the heart of our investment philosophy lies our key focus on risk-adjusted returns. Liquidity is provided through tradable assets that the fund holds in bank instruments, which can be converted to cash quickly. The Momentum Enhanced Yield Fund has managed to outperform its benchmark of STEFI plus 0.5% over the relevant time period as well. I'll now be taking you through our best of blend income fund, which is the Momentum Flexible Income Fund. Nominal bonds have experienced a tough quarter and year due to high inflationary and hawkish central bank environment. Global nominal bond yields have sold off and returned low to negative numbers. We are, however, still of the view that nominal bonds will deliver decent real returns over the medium term given the inflation and growth outlook. It is the first time in more than 20 years that we have seen the dollar trade below parity into the euro. The South African inflation-linked bond yield curve remains steep but less attractively priced on a real basis. With inflation expected to average around 6.5% and 5.5% over the next 2 years, the 10-year inflation-linked bond trading around 4.5% real looks less attractive from a valuation perspective. We have reduced our overweight view on South African inflation-linked bonds. Break-even inflation levels are elevated and closing of the break-even inflation spread will benefit nominal bonds over inflation-linked bonds. We believe the Flexible Income Fund is structured to deliver on its mandate of positive real returns over the appropriate investment horizon. The fund has therefore outperformed its benchmark of a CPI plus 2% over any 3-year rolling period. From an outlook perspective, we remain of the view that South African income assets are attractively priced to deliver high nominal and real returns over the appropriate investment horizon. In the short term, the volatility in markets will create an uncomfortable ride for the remainder of this year. But as central banks high grades and inflation returns to normal levels over the next year, we can expect more attractive returns from nominal bonds. Thank you.
Good day, my name is Nkosana Nzima and I'm a Global Fund Specialist representing Momentum Global Investments to the South African market. A point of reflection is a good starting point, as I would have presented the results to the end of June, 3 months prior to this. Everything was pretty much red and in negative territories. And I remember mentioning that the S&P 500 had the weakest start to the year since 1974. Global bonds had not offered any protection during that period. Although we had a very strong July month after the previous update, the remainder of the quarter proved to be very much challenging. Developed market equities and bonds realized further losses, and emerging markets did not do better either. There were very few places to hide, and diversification has not yielded any results in this instance, as seen in the traditional 60-40 portfolio returns. Looking at the portfolio returns, as shown in the asset class returns, in absolute terms, it's been a bloodbath throughout the portfolios. But in relative terms, the portfolios are doing well and we believe are well positioned with the recent additions to the portfolios. Looking more closely at the Momentum Global Cautious Fund, the fund does have a slightly higher weight to growth assets than most of the funds in the category. And as a result, we have experienced bigger drawdowns than other funds because of the bigger sell-off in growth assets year to date. Although the slightly higher allocation to growth assets has caused pain in the short term, The marginal risk taken is well rewarded in the long term, and the fund is likely to benefit more than its peers from a market recovery. Thus, the client should be comforted by the fact that the portfolio has held up well over time and has gotten clients through other crises like the global financial crisis and COVID, provided they had stayed invested throughout the period. Now, looking more at the Momentum Global Managed, as I've shown in the prior numbers, diversification has not yielded result in this instance, and the 60/40 portfolio has struggled as a result. The fund does have a higher allocation as well to growth assets than average fund in the category and has struggled slightly in the short term, but well positioned for a market recovery. Now, looking at the Momentum Global Growth, the fund has had a strong September in relative terms and is currently in the second quartile on a 1-month basis and doing well in long-term numbers. Just as a reminder, these returns would have been filtered through to the rand-denominated feeder funds in which they mirror. However, the US dollar appreciation would have erased some of the losses suffered in the hard currency fund. Now, moving on to the outlook and what we're doing in the funds, we still believe diversification is the only free lunch in investment management, and we continue to use it by diversifying our diversifiers throughout the portfolio. Our inclusion of private equity in the portfolios gives us access to a lot of exciting companies and opportunities that we would not necessarily have access to, and we get to benefit from the growth of these companies. We continue to blend equity styles across the portfolios to be well positioned for different market cycles, and we have been well compensated for it so far. Thank you.